Hey everybody, welcome to March. Monthly update time. Got a lot to talk about. We have a brand new war that's happened since we spoke last. We have a 5% market correction. We have AI that continues to change the way we live our lives every day. So a lot to cover. We're going to get to all of it. Let's jump in. Okay, let's jump in. So let's start with the 5% correction that we found ourselves in. So as we kind of mentioned in the last video, maybe the video before there, the market just kind of overall looked like it's getting a little bit toppy. Made a pretty kind of smooth move up off of the lows from last year. So it just looked like it was getting ready to maybe roll over a little bit. That has happened. Now we have one of these very common 5% corrections that we talk about all the time. So as a refresh, there's been 245 5% corrections since 1927. The way we gauge what may happen after a 5% correction, it comes from how long the 5% correction takes. So the way the data works, and there's actually a study that was done by Andrew Thrasher. It's called the 5% Canary. I actually did a video about this like 2 years ago. But the way the way the data works is if the 5% correction takes less than 15 trading sessions to happen, that is a signal of further weakness. Meaning if it's a fast correction that goes down 5%, that usually leads to more downside. On the flip side, if the 5% correction takes longer than 15 sessions, that has actually been a bullish good signal in the past. Meaning that when that's happened, when a sell-off spend is kind of slow, that usually leads to good performance in the market going forward. And it makes sense. If a 5% correction happens quickly, that means something happened. There's something is broken somewhere in the system where people are freaking out, and that usually isn't just the end of it. A slow correction like we've seen, because this correction took 27 sessions, so kind of a slow drift down, it more usually just means that the market's gotten toppy, looks like it wants to roll over. There's not really any real catalyst for why the market should roll over, other than it's just gone up for a while. And those are the perfect types of pullbacks that we want to see, where it's more mechanical, just like we've moved up for a long time to take a little breather, take a little break so we can regroup and continue our move higher. So I think that's where we find ourselves now. That being said, of the 245 5% sell-offs, as you can see on the screen there, the median after the 5% correction is over is down about 8%. The average is down about 11%. But again, those encompass the ones that are end up being down 50% because something is really broken in the mechanics of the market, and we're just at this point not there yet. So that's a good thing. Let's take a look at just kind of the overall chart of the market here. So main things here, and again, this is just the S&P overall market cap weighted version of things. So straight blue line down here is the trend line that we talked about last time. That's gone back for a very long time. If we zoom out to like a little bit longer. So this is going back all the way to the pandemic. That trend line has been in place for a long time. We're still pretty far away from that. If we zoom in a little closer though, we're getting pretty close to the 200-day moving average. So that'd be, I'm not even sure I think we get there, but that would be a place that we would potentially find some support if we did end up turning around. But even over the past couple of days, the market's bounced a fair amount since yesterday and today. One thing that is kind of funny and entertaining, I guess, in a way, is that, and this is a good thing for us, for the market, is regardless of what you think about his politics, President Trump, he does not like to see the market go down. So it's almost like clockwork when the market gets down 5% or when the market starts to feel uncomfortable, he will come out with a tweet or a press conference or something to to lift the market spirits, and he did that yesterday. And it was just a tweet that, or he just mentioned to a reporter that the war in Iran is getting pretty close to being over. So that sent the market straight up. It's continuing that bounce today. But I mean, again, it's nice to have a president in the office that at least that doesn't like the market go down and does what he can to prevent it from going down too much. So that's good. It's kind of like a Trump defender model where if things get too ugly, he'll step in and do something. So anyway, that's where we see ourselves right now. Is made that dip 5%, a little over 5%. We've seen a bounce right now. Before we feel too comfortable, one of two things has to happen. The first one is we just got to get back above this 50-day moving average, the green line. That would be first step to saying, hey, maybe this dip is it, and there's no more future dips coming for a while. Until we get above this green line, this chart could easily roll over and have another leg down. And then finally, just getting back to all-time new highs. That would be a better sign that maybe this dip was it and we're on the way up for a while again. So until either one of those two things happens, we're not really out of the woods yet, but bouncing at 5% is a really, really super common thing to happen. And then it's just a matter of do we stay above that line or do we make another move, like one more leg down before we start to bottom permanently and go back higher. A couple kind of risk items to the market. One, and this is probably the biggest one right now. The reason the Iran conflict matters is the Strait of Hormuz and oil. Oil has seen a move higher over the past couple weeks that I'm not sure we've ever seen before. So it went from under 60 to over 120 in days, which is very unusual for oil to do, obviously, and it's obviously caused by a supply disruption. They say the Strait of Hormuz has actually never been closed, and it really hasn't. It's just ships stop going through it because they don't want to go through it, and that's the situation that we're in right now. Is there was a few days where there was just no ships going through it. The issue though with oil being expensive is it can lead to inflation. It can lead to a recession. If goods start getting more expensive, leads to inflation. That means the Fed may need to raise interest rates in order to calm inflation, which the market's really not going to like. And it could spiral. That kind of thing could spiral into having real economic consequences. So again, that is to be seen. Not sure if that's going to happen or not, but it doesn't look like right now. I mean, oil's already way off of the highs. So unless things take a turn for the way worst, it doesn't look like that's a huge risk on the table, but that is what the market was really freaked out about for a while there. Obviously, the war in Iran, even though Trump said it's pretty close to over, who knows how close it actually is to being over? But that'll be the thing that's on the market's mind until that's a little closer to resolve. I mean, it's the same thing that happened back when Russia invaded Ukraine. That had very little to do with our economy, with the majority of companies out there, but the market still really didn't like it for a while until the market forgets about it. The market cared a lot about the war in Ukraine for a couple weeks, and then all of a sudden the market's onto something else, and whatever happens in Ukraine has no effect on the market whatsoever. This is probably a similar situation to that, where it's just going to be front and center for a few weeks, and then the market's going to move on to something that's more pressing at that time. All right, so lastly, I mentioned AI. So this is going to be an ongoing topic for a while now because the speed at which AI is being developed and being improved and changing the dynamics of the market, but just the overall economy is shocking. It's absolutely bonkers to see how fast things are progressing and how fast things are and will change. For the good, a lot of for the good, but some also for the not so good. I mean, it just depends on who you are. But for the market, there's the downside for the market, and we've seen this a lot, is we see sectors of the market really getting pounded, depending on what AI headlines are out there. So, for example, if you look at like IGV, which is the software ETF. It's a bunch of just software companies. It's obviously had a very, very rough time. It's down, almost 40% in weeks, not even months or years, but weeks. It's really, really done poorly, and that's because there's a huge worry that AI will replace or at a minimum dramatically change the way that software companies work. Like right now most software companies charge per seat, meaning that per user basically. As AI progresses and things change, that pricing model could change, which would reduce margins. It would make software companies less profitable. Plus now, with new innovations like, for example, OpenClaw. I know I'm probably getting in the weeds a little bit here, but OpenClaw is essentially a brand new software platform that was invented. It was launched literally maybe a month ago, maybe 2 months ago, but very recently. And what OpenClaw does is it essentially takes the brain of like a ChatGPT or an Anthropic or any large language model that's out there, takes that brain and it essentially puts it in a body, meaning that brain can actually do stuff now. So it can build things for you. It can send emails. It can answer calls. It can set up reservations for you. It can do a bunch of things that, like ChatGPT by itself couldn't do before. So, I mean, I'm sure a lot of you have used ChatGPT, for example, before. It's really, really good at like asking questions or answering questions for you. Like if you ask ChatGPT a question, it'll answer you. But if you tell ChatGPT to send an email to somebody, it can't do that. It's stuck in its own environment. OpenClaw lets it out. So this is going to have a major change. I mean, maybe like a culturally significant moment in time change going forward on how the entire world operates. Because now all you have to do is tell OpenClaw, build me something, and it will do it. And if it's a software program, it'll build you the software program, and you don't have to know how to code a single line of code at all. So, for example, coding engineers is not, if you have kids and they want to major in coding, bad idea. There's not going to be a need for that because computers can do that now for you. The good news is people like myself who don't know how to code but know about, can envision kind of what tools would be really, really good for helping us serve clients better, make portfolios better. Now we can build all this stuff that we used to only be able to dream about. Now we can build it and not have to know how to code, but the end result is a super effective way of improving just the experience of everything that we do. So that's a very, very big blessing, but depending on where you are in the economy and what sector you're in, it could have a major disruption in how the particular sector works. So there's going to be a lot of really, really big winners out there, and there's going to be a lot of really, really big losers out there. And that's also what we've been seeing is that we've seen some sectors just get demolished and some do pretty well. So anyway, that's we're really early in this process for AI. It's moving so quickly that AI engineers are their projections on future changes are like in weeks or at the most months, not years. They're saying we can double or triple the capacity of whatever it is by like next Tuesday, as opposed to in 3 or 5 years. So it's moving so quickly that it's going to be really interesting to see and watch and see how it all plays out. But it will have a major impact on some parts of the market. So anyway, that's what we're keeping our eyes and ears on to make sure that we do our best to be in the right parts of the market. But generally, I think if you look over the long term, it's going to be a very, very big net positive to the overall market. And I think that the market will likely do very well in the coming months, years, and maybe even decades, depending on how well this goes. So in very good shape long term. If we're going to have to go through a correction, this is about the best way to have that happen. So that's good. And that's what we know. So I'll cut it there. If you want to talk more specifically about anything I just talked about, be sure to set up a meeting with the link in the email. I'd love to talk to you and kind of go over whatever's on your mind more directly. But if not, we will talk again in a month and see how things look at that point. Hope everyone's doing well. We'll talk soon.